how to navigate the twists and turns in the market at the current juncture, let me also bring on board Sandeep Bagla, CEO of Trust Mutual Fund, to understand how one should navigate the current setup. Sandeep, lovely chatting with you. It's been a while. All the major events, most of the major events are out of the way. The budget, we had a rate cut as well, and now the important trigger, of course, the meeting between Prime Minister Modi and Donald Trump. That's going to take place over the next 2 days. But we have seen a vicious fall, and that the pace of the fall has been a little alarming. And particularly for the post-COVID investor who's not really seen this kind of a sell-off, what would your advice be, and also how are you approaching the market now?
Hi, good morning. I think it's always good to learn new things in the market. So it is probably, the blossoming of the investor who has come post-COVID, that, the lessons are learned and then we move on. We can only take evasive action and adjust our portfolios and strategies. You are absolutely right. I have heard anecdotes where people have gone out of the market, put money in FDs, or have stopped trading. There have been margin calls and all the things associated with sharp falls, which are slightly technical in nature. I think the fall also has led to a reality check in terms of what the fundamentals of finance and investing are about. So I guess this is a phase which is tough, but in the overall longer term, in the scheme of things, it will lead to a lot of knowledge for the newcomers, and it will be good in the longer term.
Okay, it will lead to knowledge, of course. It will lead to the blossoming of the new investor as well. But what should they really do? Should they sit tight and do nothing about it, or should they just make some adjustments to their portfolio and utilize this market fall? Or should they, look at booking profits wherever they can? What should the approach be for these kind of investors now?
So the broad advice would be that, keep calm and stay invested. India is a structural growth story. I don't think anybody or any global events can really move India away from the growth path. The trajectory can become, slightly weak for some time to come. But I think the demographic dividend, the democracy, the digital initiatives that we have taken, I think these are all pillars on which the economy will grow steadily and strongly over a long period of time. So I think those factors are very much intact. In the short term, what we can do is we can take a look at our portfolios. We can cut out the stocks that we do not know anything about, which are speculative in nature. Do resort to asset allocation with the help of an advisor or an expert. The age-old wisdom is something that you cannot deny. 40 to 50% of your household wealth should be in fixed income oriented assets which generate a regular income, and 40-50% should be in growth oriented stocks or portfolios which have a good combination of large, mid and small caps. No category in itself is bad. Some overvaluation was there which has corrected. Can it correct more? Yes, it can correct more. So make sure only the long-term savings that you have, which you do not need for the next 5 years, 3 to 5 years, should be there in equity markets, and lower your expectations. See, if the inflation is at 4%, you will get 7-8% in fixed income. If the nominal GDP growth is 12%, then you will get 12 to 14% in your equity portfolio over long term. So stick to the basics and lower your expectations.
Well, stick to the basics and lower your expectations. And most of the experts I have spoken to have pointed out that this year, don't look at or don't expect to make easy returns in the market. It is a year where the focus should be on capital protection. If we talk about portfolio rebalancing at the current juncture, using this market fall to buy into stocks with attractive entry points, any particular pocket that comes to your mind, any adjustments that you are making to your portfolios? Take us through that.
Yes, we have made some adjustments to our portfolios, but we are professional fund managers and we keep track of the economy, keep track of the companies, keep track of different sectors, and we can make adjustments quite quickly. We do not have to pay tax. We do not have considerations which individual investors have. So we are right now a little overweight on pharma and IT. We have increased our weight in the large banks, which are more stable. And over the long period, we are more bullish on Indian consumption-oriented stocks and Indian manufacturing, which is likely to gain from the government initiatives, PLI schemes, and the fact that people are moving away from China and diversifying. So, these are the themes that we are bullish on currently. But as I said, we can change our stance and portfolio positioning fairly quickly. But these are the long-term themes that we are currently bullish on.
Just taking a leaf out of your answer, when you spoke about large banks, would you be tilted towards private banks? And also, when you talk about consumption, within consumption basket, you would look at staples, or would you look at something else?
No, we would be more attuned towards discretionary because we feel that the economy will grow in those segments faster. Uh, Staples have only limited growth. So we are high growth investors. We believe that India is a growth story. It will continue to grow at a faster pace than other countries. And within that, there will be sectors which are emerging, and there are companies that will grow faster. So we are looking at high growth opportunities in among the banks. We are more concentrated right now on the large private banks. And in BFSI, we are looking at opportunities in capital market oriented companies, which are linked to the mega trend that we are seeing, which is basically financialization of savings. So that is our bent of mind right now.
What about insurance? Do you think the worst the worst may be over for some of these insurance names because all these regulatory overhang? Would you say that all that is factored in? Because yesterday, in the new income tax bill, we are given to understand that corporate tax rate for insurance companies have not been raised. They have not been tinkered with. So no good news. I mean, no news is good news for the insurance sector as of now. So how would you approach this space?
See, it ties up very well in our overall theme that, as Indian more population is coming into the workforce, people will need to insure themselves, will need to save better, invest better. And so it definitely fits into the overall theme. But at the current juncture, whether the valuations justify investments or not, that I'm not very sure of. So that is my investment team's work. I don't think we are very overweight on any insurance stocks, right?
Okay, not overweight on insurance. Last question, really, what would you do with realty? This pocket or this sector has seen a vicious fall, and thus far, luxury housing was driving gains here. But with tax cuts and rate cut as well, there are hopes that affordable housing will also see increased demand. Valuation wise, would you approach realty then in that case?
Realty is obviously a very, very important sector and very integral part of the economy. But with this kind of market fall, there would be a negative wealth effect, I guess, and I really would venture very strongly or very heavily in the realty sector right now.
Okay, realty sector and avoid right now. And one more question then. We had the Amphi data yesterday. We saw that equity mutual fund flows have increased on a month-on-month basis, and all categories, mid cap, large cap, small cap, have seen inflows. Would you, despite the kind of pain that we saw, the brutal sell-off that we saw in the market, investors have kept their faith for February and coming months. Would you think this trend will continue? And even in terms of SIPs, in such times we see sometimes that people stop their SIPs. Would you like to reassure them or perhaps tell them that it is, you must really continue with your SIPs and not stop them in a panic state?
Oh, any action taken in the panic state is not great. We are seeing a lot of new investors who are doing their KYC and coming into the mutual fund investment space. So new investors are also coming in at this point of time. I think if you have the right asset allocation and if you have a long enough investment horizon, I don't see any asset class as where you should stop your SIPs or you should increase your SIPs. I think one should keep calm and stay invested.
So, what are the kind of funds that one can look at, in terms of asset allocation?
See, I think one should look at flexi cap funds because that gives the maximum freedom for the fund manager to rotate between different market caps in different segments, and gives the onus of allocation of money to the fund manager who probably knows best amongst us. When we invest in sectoral funds or any other kind of funds, that allocation is we are doing the allocation, and I think this is a time where the fund manager, if he applies his mind and has an action bias, will have a lot of opportunities to protect the downside and to capture the upside whenever it emerges. So flexi cap funds.
Okay, flexi cap funds. You can look at investing in these funds at in this market texture. But with that, Sandeep, I would like to thank you for taking out time and joining in this morning. Always a pleasure, and I look forward to more interactions going forward.
Thank you so much, Nita. Thank you.